swingers, quants, traders, and market participants. Welcome to Inside Traders. This is a show where we talk about markets. And in our last episode, we were talking about the benefits of selling calls to earn income. And in today's episode, we're going to be continuing that discussion and talking about how to create a indestructible portfolio. Because you might have enemies out there, and what if they were watching your trades, and every time you place a trade, they make a move against you, and so you have this scary situation. Or let's just put it this way. We want to build a portfolio that is indestructible. So I have on the screen GDT teaching us about the barbell portfolio, which I believe was pioneered by Nassim Taleb. I'm not 100% sure on that, but that's where I first heard it. That's the source I found. And the idea of the barbell portfolio, let's have GDT tell us. So the barbell strategy involves splitting investments into high risk and low risk and avoiding everything in the middle. Think of it as loading a barbell with weights on both ends. On one side, you've got low risk, stable assets like bonds or cash equivalents, or in my case, and in our case, if you're following my system, sold calls. But anyway, on one side, you have risk-free, and the other, you have max risk. And that is how things end up being evened out. And so imagine, I've done this before, where I had a barbell portfolio filled with sold calls, and I was not getting any traction because the weight of those sold calls was making it so that my portfolio just if it went up, it was grinding up so slow. And so I sold those calls, and then boom, instantly the whole portfolio blew up because I actually bought those calls back. And then I bought more out of the money calls. And it was because I had all of my risk on one side. And so the portfolio was out of balance. And I'm not sure if you guys can hear that. Is there clicking? Is that just me? Something's clicking. Let me try wiggling a wire. Nothing. Oh, nice. Okay, I wiggled that and it seems to have fixed it. So the idea of the barbell is that you have one side that's risk off and one side that's risk on. And I have had it where I had a pretty sweet setup in terms of having all these sold calls generating income and paying out a dividend of sorts. And then, like I told you, I got frustrated that the portfolio wasn't moving. And so I bought back those calls. And let me tell you, it moved fast to the upside and then to the downside. And so, especially in the world of options, it's really important to balance the other side of the trade. And how do we balance the other side of the trade? Well, you could just use cash. You could use T-bills, treasury bills. You could just use anything that's generally seen to be risk off. But in my world, I want to essentially take $1,000 and be able to turn it into unlimited money over many trading iterations. And so how do I do that? Well, to me, there's only one way to do that. And you're never going to get there with compound interest, right? You need to be generating a income, a premium. You got to be selling something. And so in my mind, what you could do is you could sell you could sell risk management, meaning that the market will pay you to carry risk. So if you sell a call that is pretty close to the money and far out into the future, you're going to net a huge premium. And then what that's essentially going to do is kill those shares, which is like pretty terrible if you're paying a margin cost on those shares. And so you have this really dramatic risk to the upside now with a sold call. And so the key to all this, and it has to be dynamic and in real time, and I haven't even come close to achieving that yet. But the key to all this is balancing the barbell. So like your portfolio should be as much risk as you can possibly manage on one side, and you've managed it however you've done it on the other side. And like I say, in my world, I like using sold calls to manage risk. And the thing is, it's impossible to go to zero with sold calls. It is impossible to go to zero with sold calls. The lower it goes, the more effective they're going to become. And because of the momentum associated with option pricing, which is really, I think, probably just a factor of moneyness. But I think moneyness in time works on some kind of like acceleration curve in terms of option prices. I don't know that, but that's how it seems. So that like, even if the stock price stabilizes, the options can still drain away for like a few days. And even if the price is going down, the options can still like stay steady. So like, it's not perfectly predictable, the option prices, but they definitely have some momentum to them. And I think that momentum is what's so special about calls versus puts. With puts, you have a defined risk and a defined reward. With options, you have unlimited risk, so unlimited reward. And if you expose yourself to the unlimited risk of a sold call, that actually does install a floor that is like a magnetic floor that you can pass both ways through. So like, imagine there was this threshold and it was the strike price of your sold call. And however far you were above it, it was like holding you back in a way with like a magnetic force. But then however far you were below it, it was then pulling you up with that same force. And so how do you balance the trade? Well, we already know that we're getting a great benefit in getting this cash premium for a sold call. Now, what we do with that matters a lot. So, for example, let's say you continuously just bought into the same shares of the company that you sold the call on. Well, you're going to, and then you like keep selling calls on that. You're going to get into this situation where like you're paying a huge margin cost for, I'm like somewhat thinking through my history here of like, cause I started with this, I'll have to tell you the full story sometime. Like, but just to stay on point, like so you have this sold call and it's acting like a magnet and it's either holding you up or it's holding you down. Depends on if the sold call is supporting you, although like in terms that you're below the strike price, or it's resisting your upward movement in the terms of being above the strike price. And so, like I said, we're getting this great benefit in having this sold call. And what happens is if you put it all just like back into shares, you're paying too much of a margin cost. First of all, let me be clear. Use max margin or GTFO, not really. Like you can stick around if you don't want to use max margin. But in my strategy, like there's no way to turn $1,000 into anything meaningful without margin, right? Like the only thing that makes anything that I say on this channel possible is margin. And we want to learn how to always be using our maximum margin every single day and to grow that margin and use it tactically. We want to use it carefully and tactfully, tactically, and tactfully. We want to do all that. But no, we want to be tactical with it, meaning we want to be precise, surgical. We want to buy, for example, every day at the top or the bottom, depending on what we're buying and selling. We want to have really good entries, really good exits, and trade around using that margin, because that margin is freaking sacred and it is not to be burned. As much as I probably burn more margin than like anyone I know. And I've met some people. And so, yeah, anyway, like margin is a very delicate instrument because it can burn you, and it can be the accelerant. It's gas. I mean, really what it is amplification. And so anything that makes sense to you, to me, the easiest thing to think of is a feedback loop. So something that is more every time it's iterated. Anytime, like if you get like two speakers close to each other and it goes whoa, 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 and then it just kind of like blows out. That's a feedback loop. And margin is really good at creating feedback loops. Especially if you get on a trend or a couple of trends. And so markets are all about momentum. The worst thing you can do is play the opposite side. The times in my life where I've gotten my face ripped off, almost rightfully so, is when I was just betting against the market. Like, that's so... Why would you bet against the market? At the time, I was doing it because I really didn't know I was betting against the market. But looking back, I can see so clearly that it was. Now I don't guess. And this is part of the point of this show. I just look at the order flow. And if I want to buy something, the first thing I'm going to do is go and see what other people are doing. And we can see people are buying up Tesla like a lot. Very bullish in Tesla today. And it was because of that drop this morning. And so coin. Now, like, it's not perfect, right? Like if you were to put an arc, we have a bull call. There you go. It's actually, well, it's kind of still like kind of not super bearish. But yeah, it's not like bulletproof in that you can like just use the order flow. But in general, if you're looking at the sentiment for the day, let's get that on the screen. It says bearish. Watch this. There's no way. I mean, maybe Apple made it bearish. People are putting Apple in its place. It's pretty epic. Yeah. So I bet if we also remove Apple, it's going to be way more bullish. No, never mind. So we had a lot of premium going. Oh, wait, that brought in SPX. Minus SPX, minus QQQ, minus SPY. Okay, so was that more or less bullish? Let's see. Yeah, so a little more bullish. So people were freaking bearish on Apple. We should look at why in a minute. And so today was the wrong day to be a bear. Like every put I bought got burned, and not really, that's not really true, but like it's the wrong day to be a bear. You should just go with the flow, as they say, go with the order flow. And let's look at Apple and see what's going on. So I guess they are not having the growth that people want. Bearish. Wow. I mean, there are so many, like this stock is in every pension ever made. It is gotta be one of the most widely held names out there, actually. So it's kind of hard to go wrong on Apple, but I do think it could get sliced back to a lower level. Like I talked about in the past, it might not be a bad idea to short some of these companies. Like, look at how safe Tesla is. This is why I feel like so safe with Tesla. It's just at 250. That's perfect. That's right where Tesla belongs. Is at 250. It's perfect. Now it's going to move around and do whatever. But in terms of where it should be, it's a good level. But it's been years, not years, but yeah, years since we were at the all-time high of 420. And you know that we got to test that. You know we got to test it. We already tested the lows here, 90. So there's only one thing left to do. And that is to test this one. And because that's what the price wants to do. It wants to boom, 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 and bounce around until it finds an escape. And the escape can be to the downside or the upside, but it doesn't want to stay where it's at. It wants to move. And so, what's this, our 200-day? 303. Wow. This looks constructive as fuh. Look at that. Is that a saying? Can I say that? Constructive as fuh. Yeah. Anyway, Tesla's looking so good to me these days. Might have to do a couple of long-term calls. If we get another dip below like 220, it'd be nice to get a dip below 220. And guess what? If you sell calls, you have no fear of a price going down. You always and only see opportunity. And what's really interesting about having sold calls is they just give you this baseline of delta, and you can calculate it. And I'm working on calculating it. None of it's easy. I've been working on it for months. Like, it's not easy. Literally this calculation, just even gelling of it, thinking of it. But essentially, I think I've got it figured, which is take all of the negative delta of all of my sold calls, probably per expiry period per stock, but let's just start by saying for the whole portfolio, because that makes it simple. And then that is your floor. Like, that is the delta that you have to play with a little bit, right? Because we also have to consider our shares, the positive momentum of our shares. And so easiest way to do that to me is to use the cost average as a synthetic strike price, and then just look at this or next week's expiring option, find your strike price compared to your cost average. Boom, that's your delta. That's your positive delta from shares, each block of 100 shares. So then you sum those two, and like, you're going to have more positive delta than negative delta for sure. Right? Like, I'm pretty sure there's no way to sell over 50% of the equity. Like, you could probably get to like 49,999, but I don't think you can sell over 50. If you can, maybe you can. I don't know. Actually, I'd have to think about that, because like, you could just sell deep in the money way below your strike. So I suppose there would be. I would never sell. Like, it's like a spread trade. Think of it as a spread trade. Your shares are the positive delta. Your sold calls are the negative delta. And however many clicks away from the money you go, that is from your cost average. That is the width of the spread. And so the way that I sell calls, you need to go probably a couple clicks away to make it even remotely worth it, just because you're paying a lot of transaction costs in terms of, you got to pay the brokers, the market makers. They're going to want a premium for always giving you liquidity, and which is like amazing. Like, happy to pay that premium for the liquidity, because it only really matters that we're directionally right in the course of like weeks. And this comes back to like why I'm back. It's so funny. I've come full circle. When I started the show, I was all about these 0 days. Now I'm all about like the longest term possible. And I see the value of both, and there's a way to do both. I'm not set up to do both right now. But I can see how it could be set up. So where are we? We're like selling calls to get a premium. That is the safe side of our barbell. We're summing up all that negative delta to use that as kind of like our budget. That's our budget for how much risk we can add. And we then consider our shares as virtual options by looking at this week's expiring contract whose strike price matches our cost average. Got it? Got it. So, like, this is where you can really set risk, like with a dial one day, with a dial. And the reason you can set risk with a dial is because if you know your negative delta and you know your positive delta, then you got your spread figured, and you can basically just go almost by the market sentiment in terms of like, I need to add positive delta through purchased calls, or I need to take advantage of this price decline by doubling up on my negative delta. So like as soon as you purchase, this is a lesson I learned such the hard way, shorting NVIDIA. Oh my God. 2 lessons I learned that day. One was the power of volatility, or rather in this case, the crushing weight of volatility crush. So I'd bought this put that was like $2,000. Oh my God, did it die? Like you can buy a put at the money, that expires like 90 days out. This is like why you're crazy to hold puts into, like, why wouldn't you always sell your puts? Anyway, point is, you could have had a great put, great strike, great expiry period, and it's still going to expire, or it's still going to lose like half of its value because of this IV crush. And so my idea was like, okay, I'm going to short NVIDIA. How am I going to, this was at $360. I wanted to short it because it was like 280. And it was like, I mean, you know, this is like why all of these rules about like the charts, you know, like it's all kind of goes out the window, because it's not, you can't count on anything. Nothing is like perfectly reliable. So NVIDIA's 200-day was 245. That probably was a pretty good, I mean, they really have had these incredible earnings. It is incredible. Wow. So yeah, where did I try to short it? Like right here. I tried to short it like right here. Maybe like right here. Oh yeah, it was 360. Yeah. So I tried to short it in this range, and in this gap up was where I learned about that IV crush. Now, it actually ended up working in my favor, although I didn't know it at the time, because the price of my sold call also went down. I was hoping to experience something like that with Path today, but I didn't quite get it, which means that the vol wasn't that high when I sold the calls, but it was elevated. I could tell it was elevated. And so anyway, there's all these arbitrages that are possible using time and volatility. And essentially what I'm proposing here, which is a barbell portfolio that does use a time and volatility arbitrage, depending on how you do it, to manage risk, then yeah, like I said, you basically just turn the dial however you like. So if the market sentiment is super bullish, probably a good day to turn the dial up on the positive delta. If the market sentiment is bearish, probably want to turn the dial to negative delta. But the point is, sold calls make that really easy. And they also just give you a ton of opportunity, because if you do get it right, and I got this right a few times now, and it's freaking awesome when it works. If you get everything right, then you're selling a call at the top. And so it's like selling a call like right here at like $500. And then you're buying it back again at like $400. And the reason you can buy it back is because when you sold that call, you took a part of that premium and you put it into a perfectly placed put, which means that it was like, let's just say you bought a $500 put a month out, and then 3 weeks in, it was $400. You're going to sell that put for 10x, and then your sold call has dropped in half. So not only do you get this put, basically you buy back the calls with the puts, and now you have unhedged shares at the bottom. It's going to explode. when that happens. It's really fun and cool. And I've had it happen a few times. And if you get it wrong, then you burn the put and nothing happens because you already had the sold call. But guess what? If you didn't sell calls, you wouldn't have had that opportunity to begin with. And so in my mind, this is another thing I think is like really great about options is they give you more options. So like there's a way to get around all these limits. Let's say you can't do day trading on Robinhood because you don't have 25 grand of equity in your account. You're like a kid. It was hard just to get $1,000. Well, what you could do, and you shouldn't because this is risky, I'm just saying it is humanly possible to do it, is you can always just switch what contracts you buy every other day. So like, let's say you bought a contract that was thinking that Tesla was going down at 260. And so you bought a put. And then at the end of the day, you want to sell it because you were right and it was at 250 now. So what you can do is if you sell that put, that's like a day trade or whatever. What you can do is just sell the put at the click right below it. Well, now what you've done is you've opened a spread. Now you have to have the right options level and probably accounts to even get to this level. So it's probably not doable for most people. But the point is, now you've just opened a spread, which is like even more valuable than selling. Because guess what? If the price continues to go lower, then you still have that put protecting you. And you could buy back that sold put at a small loss and get the full benefit of the put or whatever. Like each one you do gives you options. The worst case scenario, you just close them both for a small credit and whatever, just take whatever you made from that spread. But it's pretty cool how everything with options is like, you can just infinitely like you could buy a call. And then instead of selling it, like let's say it goes up 25%, you're not sure. Well, you could just sell the call right above it. Okay. And now you're getting that credit to your account. And then what would be just so lucky is if the stock price immediately fell after that, and then you had an intuition to buy back that call and then also buy another one or whatever. And then you get like a 3x. And so, but you couldn't have done that if you didn't have the credit from the sold call to begin with. And so like learning that wherever you have equity, you can create liquidity is pretty important. And yeah, wherever you are in the chain, however much time you have left, you can always exit a little bit of liquidity from your options. But doing so creates a spread and limits the potentials of the return. It's essentially defining your risk. That's kind of what's cool then about calls versus puts is you actually can define your risk with calls, but you can do it post hoc or like post placed trade. I don't know how to say it. Like you can place the trade, then whatever's going to happen is going to happen. Let's say it goes up. Now you sell a call and you already have a profitable trade locked in. It's locked in. And then if it goes down, well, hey, you have the credit from that sold call. That's awesome. You can close the whole trade and just pay off the sold call with the value or vice versa of whatever. But it lets you then define your risk. Not something I've exactly thought of before. So that is what's cool about options is they have unlimited upside or unlimited downside, but you can then use them to create these spreads. Pretty cool. So yeah, I think that's mostly what I wanted to talk about today was the barbell. And that's the idea of how I want to run things. And the hard part of what I've discussed, besides understanding it all, is and actually being set up and primed to be able to do it and test and to see if what I'm saying is like accurate for you, is what's the hard part? Is actually quantifying your risk And how are you actually, like, I have a system that I know all of the delta of all my calls, but like it took a lot of time and energy to build that. And I still don't have it with shares. Like I need, like I said, this virtual thing. I gotta see if that works. Cheers to Yeti. That's kind of cool, right? Technology. So yeah, that's kind of the idea is we use sold calls as the safe side of the barbell, but let me tell you, it's not a walk in the park. Like you can get dominated by the weight of that sold call. And so you really have to be judicious and careful with your additional margin. What you do with that premium is everything. That's everything. And what you need to do is balance out the trade according to the sentiment. Because if you're always using max margin, then obviously you're an active participant in the markets. I'm not always going to be an active participant in the markets. You don't have to use max margin. You really don't. In fact, the more calls you sell, the less you have to think about markets. That's for sure, because you have that insurance. Not only do you have that insurance is you're benefiting from the time decay. So the longer you hold that sold call and it stays out of the money, the more you're benefiting from the theta decay, which is why people generally like to sell calls about a month out, because that's when the theta decay really ramps up, but you're not going to get any good premiums at that level. I'm talking about like exiting double-digit percentages of the equity and then using that to amp up your margin. And by amp up, I mean amplify your strategy in whatever direction it is. And what I think it is look at the macro, look at the, not micro, but the mid-cro. What would you say? The macro, if it's bullish or bearish, doesn't really matter if you're in a short-term decline or recession. This is why we look at the sentiment, right? Like, why guess at it? Why have an opinion on price? Here's my question. Why are you a bull or a bear? I always think that everything is going to be more awesome because I have a lot of reasons to be optimistic about the world, but the number one is that more people are born every day that want to do things, and they are going to educate themselves, and they're going to go into the world, and they're going to do some unit of productive work so they can do things. But why? Because that's what people do. What do? We go out there, we do shit, and we do, like, why do we do whatever we do? I don't know. But we certainly have evolved an economy amongst the other, humans out there in society. And in this economy, why am I making this so abstract? Like, we all just want to be able to have the freedom to do what we want to do. And that's great. Like, point is, forget whatever thread that was. Follow the order flow. Just go by the sentiment. Don't be a bull on bull day. I was talking about optimism. And we have a lot of people out there that are motivated to make new things. And so we're going to keep elaborating all of our tools, including our latest tools of mass media and the internet and AI. But also pants. That was a great invention, and we've been leveraging it for millennia. And clean water, all this stuff is leverage. All this stuff gives us, we don't have to think about clean water. And most people throughout all of time in history did. You're basically the first one who didn't. Most kings in history had to think about clean water. You don't even have any awareness where your water comes from. I turn the thing and the thing comes out, It's like, what? People died and bled for 1,000 years to make a drop, and you'll just turn it on and waste it. Yes, I will. And things change, right? Stay with the times. These times we can waste a ton of water. And so that's my message for today. Go waste some water. We can always regenerate it. And although like using this strategy, the barbell approach, we don't have to waste anything because we're always protected by those sold calls. And then we get an opportunity like with, if we're right as traders. So as long-term market participants and investors, we can benefit from knowing that we can't go to zero in that position. And if we secure every block of trade with a sold call in proportion to however much protection we want as a percentage of the price to premium ratio, the premium you're getting from the sold call compared to a block of 100 shares, whatever that percentage is like how much you can't lose. But like the whole point of it is it creates an opportunity. And if you, as a trader, you putting your trader hat on, then recognize that this is a good day to sell a call, and you do so, and you net that premium, and you're careful with it. Like maybe you hold on to it for a week, and then you redeploy that in the right way, which might have been immediately purchasing a put. Like I said before, immediately purchasing a put. Well, let's say you purchase a put that expires in 2 weeks. You've just done two arbitrages. One arbitrage. Two arbitrages. If you're right. Anyway, just let's focus on the time arbitrage. The time arbitrage is that you exited this premium for like, it had a ton of extrinsic value. What did you do with that extrinsic value? You converted it into intrinsic value. Like if you're buying an at the money put that expires in 2 weeks, it's all intrinsic value. That's all it is. I mean, there's a great premium. Like it's probably half actually. It's still, but like the whole sold call is the whole premium of that sold call is all extrinsic value. Why? We don't know. Like how can it have intrinsic value? Like it's too far in the future. Unless it's in the money, we don't know what's going to happen. Could be above it, could be below it. But when you're buying 2 weeks out at the money put, not only do you have immediate effective insurance, meaning you could literally then sell the call, in this case of NVIDIA, at $500. So like right here, you sell a call and use 25% of that premium to buy a put. And then because you're a freaking wizard, you know to buy the call back by selling your puts and using the premium to pay off the call at 405, because like you're just that big of a G or whatever, a gangster. And then like you've like tripled your money, and you've done it like you've done it in like getting paid to take on risk. So it's like a win. And it's pretty cool. It's hard to make that happen though. And it's, I don't know, like a couple extra wins in there, but it is like a win on the put because you've got it for free. It's a win on the sold call because you're managing your risk. And then it's a win on the unhedged shares at the bottom, win. And then all of that combined. Okay, a lot of wins in that. Now, nobody could actually do that. I bet people could do it. Like, I think it would be really hard to do that, like perfectly time all that. But if you get lucky, I've certainly timed things like more intraday and gotten lucky where like I sold a call, I used that premium to buy a put in close to the future. So now I already am getting an intrinsic value arbitrage for free in that new contract. And then I was right. And the price did fall. And I was able to sell that call for double or triple and pay back the call. And then the price went up and the shares shot up because they were unhedged. And then you can rinse and repeat that all day long. Now, if it was so easy to do that, you know, maybe I'd be on an island with my soulmate or whatever Uncle Rico says. But I'm not right today yet. Like, give it time. You don't know. You don't know. If we're going to get there, it's going to be from making sure that we're managing our risk, our upside, and our downside all at once. And I think that job gets a hell of a lot easier if you're a call seller. So which calls should you sell? I don't know. I mean, in my world, why not let's exit the equity from those shares, and then when we buy them back, we're essentially just like closing a spread trade. And so it's not like we're going to get some credit. It's not ever going to be worthless, is what I mean. And then, yeah, like you use that additional premium to amp up whatever your strategy is. So that's the last couple of days have been all my secrets. I'm sure that it's very confusing to people who don't know much about calls and puts, but as far as I can tell, like that it sucks because you have to be an active participant in this strategy, or the weight of your sold calls will just like completely destroy your returns, and you'll miss whole rallies this way. But that's if you're just pumping up your shares to like wherever you want to pump it up. Now, there's a limit to how much you can pump these up. Like your brokerage probably will shut you down after maybe 4x. I don't know. I think Binance had 100x. Crazy. But like there's probably a limit at how much you can drive with how much equity. But driving, like let's say you have $5,000 in, you could be driving 25 grand with that 5 grand. You know, like it's a lot that you could still drive, or 100 to 500, or 1 million to 5 million. And it's 4 to 5. It's 4 to 5, I think. It probably just depends on the rules of your brokerage. So anyway, is there anything else to talk about? Yeah, we got, the idea is not ever thinking about margin calls because we have sold calls. We're never going to get margin calling because we already sold our calls. Like they're already sold. They're right there. Look at them. They're providing value. Now, if you just exit the premium, you're not going to get a sold call. You're going to get like a leverage call, meaning like let's say you completely take that cash in, you remove it from the portfolio, and then the price goes down. Well, you're going to be forced to sell for a different reason, which is at least you won't be able to buy, but you're going to get locked out for having too much leverage. And it's pretty easy to go from like 3x leverage to like 10x leverage in like a heartbeat if the market goes down and you didn't do the right things with that premium. So this is not a risk-free situation at all. In fact, it's a way, I think, to reduce risk by maximizing risk, because taking on these sold calls is a friggin' risk to the upside. Like you are taking on unlimited risk when you sell that call. So how do we do it? We add even more risk for real. Like the only way forward is through in regards to managing risk. Like, otherwise, how can you build, like if you wanted to build $1,000 into $1 million, it is impossible to do that through any conventional means other than maximizing your margin and getting into an amplification effect. And so how are you going to get into an amplification effect? You have to be on trend. That means you're a bull on bull days, you're a bear on bear days, and your portfolio is fundamentally geared in terms of its delta towards the market action. Meaning if the market is going down, you literally have more negative delta than positive delta. But nobody could switch on a dime like that. Nobody, unless you sell calls. Because first of all, you can just roll your calls lower, exit some premium, and buy an immediate put. Like but anyway, more than all that is you're already going to have a substantial burden of negative equity to deal with, which is like why you're already taking on a tremendous risk in selling those calls. But the way to balance it out is to take a tremendous risk on the other side. And then if you do things perfect, if you get it just like the sweetest setup, you're selling the calls at the top, you're buying them back at the bottom, not with cash. No, you're buying them with the premium of the put that you purchased with the sold call. And like, if you can just do that a few times, it really does enhance your returns, because as soon as you let those shares go uncapped, even just like 3 to 5%, it's such a difference. And so, yeah, it demonstrates actually the risk of the sold call, which is the market goes up and you don't. So yeah, you got to manage your positive and negative delta for sure. And I already gave you my ideas on how that can be done. In the longest of terms, I think it's possible to automate all this using like the Tradier API, and even in Robinhood, there's things that you can do. But the whole goal with any of it would be you're getting insurance from the sold call. That is the safe side of your barbell. The only way to manage all that risk is literally to buy calls. Like otherwise you have too much negative delta. And then you have to have some way to quantify all of it. Because like the thing that blew me up this last time was not understanding. It was a few things, but like it's everything I'm telling you not to do now. Like I wasn't on sentiment. I didn't know that you could just buy the order flow. Shit. Like I wouldn't have been a bull on bear day. Like why would I have just done that? Like I thought it was bull day, but no, it was bear day. And so like, that's one thing is like, just always go with the order flow. Like, why would you spit into the wind? Why? Don't trade that day. Do nothing rather than go against the order flow. Better to just do nothing. And so that's a big learning, and a recent one. But I was telling you, we blew up because we didn't have the other side of the trade balanced. And so, yeah, I got so frustrated because this market rally, I was missing it. And so I did whatever it took to like buy back all my calls, as many as I could. And immediately, and my portfolio took off and I had all this additional margin, which I used to like accelerate the process with more purchase calls. And it was essentially like having a nuclear reactor where you remove the anti-reactant. Well, obviously it's going to be a meltdown. Like it's going to generate so much heat, the whole thing's going to melt down. And so that's exactly what happened, is all those calls blew up and the equity got burned. And anyway, like it's, not obviously nothing is ever really a total loss in markets unless you're buying options, then it can be a total loss. Yeah, like I've had these blow ups or whatever so that you don't have to. And the thing that I learned from that is to make sure that the trade is always balanced. Yeah, like it really would be like you're squatting and somebody takes all the weights off one side, you're going to flip over instantly. And so to me, it's just like the problem with buying a put is it's like I don't ever want to buy a put because I'd rather just buy a call. Like if I'm going to take the risk of the extrinsic value eroding away due to theta decay, I want that to be giving me some upside. And I guess you buy a put because you think it is giving you some upside because you really think it is going down. It's just hard for me to get my brain to think that way, although I have a few times. And so anyway, I want theta decay working for me. Like theta decay needs to be working in my favor. And so as a call seller, that's the case. It doesn't work a ton in your way, but for you, but it does have some benefits. Is the longer you hold the calls. And then it has a ton of benefits if you have like a flash crash. Not possible. You can't have a flash crash. I don't think there is a way, unless you do really dumb things with margin, to get margin called with my program. Other terrible things can happen, just not margin calls. And that's why we always use max margin, because that's the whole trick of turning us, like how do you turn a penny into a billion? Leverage. Well, like you need to be right about price and you need to have enough leverage. And so if you knew what the price would be tomorrow, you could turn any sum of money into any other sum of money instantly if you had enough leverage. But they cap those things. So, it's actually better that it's capped so that we can build it slowly and responsibly over time and incorporate all the learnings. And I think that is everything I got for you. That's all my learnings. So my first initial version was, oh shit, I can get paid to sell calls. Okay, I'm going to sell a ton of calls on companies that I think are going to zero. And that kind of worked pretty well. And then it became, holy shit, let's sell calls on everyone. And then that gives me free insurance. And then it was, this is the worst. Like the market is going up and I'm grinding out 2% while the market is up 10%. Like I'm missing the whole thing. Do whatever it takes to buy back those calls. Now we're unhedged and we have removed the anti-reactant from the nuclear accelerator and the whole thing just like heats up. And in a course of like 3 weeks, I had maybe a tripling, something like that. And it was awesome. So now the new version is do all that. And the only difference being that we never sell our calls. Or like if we do sell our calls, we have all this quantified out with like knowing the delta of the negative delta and the positive delta. And we can like see both sides of the barbell at once. And that's like super important. So yeah, this will be a new attempt. We'll see how it goes, but I'll definitely keep you guys updated. And that is kind of just the continuation of my idea from yesterday. So happy to answer any questions. And it really is impossible to go to zero with sold calls. That's the message. See you guys.